Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, to do some teaching. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Well, there's the quarter-point rate cut, and then there's Nvidia. There's Jay Powell, and then there's Jensen Huang. There's endless hand-wringing about inflation and job growth. And then there's a company with an outrageously high 73% gross margin and hundreds of billions of dollars in opportunity. I'm talking about the extreme dichotomy between focusing on a body of wizened economists who are being pushed around by a president who wants to run the central bank and focusing on the freewheeling capitalism of the semiconductor business with some bizarre federal intrusions in the age of artificial intelligence. That dichotomy plays out every day around here, including this one with Dow advanced 124 points, S&P gained 0.48%, NASDAQ jumped 0.94%. And you know why? It's because a huge percentage of the money that's invested in stocks sits in index funds, which have a tight correlation not with the companies themselves, but with the bond market. When interest rates go up, the indices tend to go down. Makes sense. Higher long-term interest rates are typically bad for business. When rates go down, the index funds tend to go up for the same reason, because almost everybody benefits from lower borrowing costs. So the linkage, it's ironclad. Sure, periodically the stock market can break free from the shackles of rates, but not very often. Yet that's the only investment most people say you're capable of owning. But when we're talking individual stocks, which I think you're capable of owning, there are plenty that are independent of anything the Fed might do. There's so much money parked in index funds that sometimes we forget that those indices are made up of individual stocks. The indices certainly weren't created for the stock of Nvidia, though. A company with a $4 trillion market cap that's not at all hostage to interest rates. In fact, it's not even hostage to its own industry, as we saw today, which is why Nvidia could make a $5 billion investment in a one-time semiconductor kingpin today, Intel, and see its own stock rally 3.5% or $150 billion in response. You spend $5 billion and you tack on $150 billion in market cap. Now that's a miracle. This is the kind of gain everybody wants, and it's much easier to get when you don't spend all of your time worrying about the Fed and quarter points and dot plots or putting the hate on the individual stocks, as almost every professional does, because they think that you can't handle. First, let me tell you these incredibly wild circumstances that explain why Intel even needed the cash so that Nvidia could make the profit. At one time, Intel was by far the most important semiconductor company in the world. It owned the PC and server market, but it didn't go into fast chips, the kind that Nvidia makes, the kind that originally for gaming, but ultimately generate artificial intelligence. Not only that, for years, Intel ran circles around advanced micro devices. But when Lisa Su took over at AMD and set her sights on taking Intel's business, she succeeded beyond her wildest dreams. Intel had roughly 85% of the PC market when Su took over 11 years ago. AMD had about 15. Now AMD holds about 40%. And in the huge server market, AMD had only 1 to 2%. Now it has more than 25%. In both cases, AMD is still gaining share, while Intel feels lost at sea, dazed and confused. A few years ago, Intel picked a new CEO, Pat Gelsinger, who vowed to stop losing share in PCs and servers while taking on NVIDIA in accelerated computing and artificial intelligence. Oh, man, he spent fortunes, far more than Intel could afford. Although he caught a break when the federal government gave Intel some big handouts from President Biden's CHIPS Act. But it wasn't enough. No, the huge foundry build-out failed to attract enough customers. Gelsinger was ultimately fired. In came Lip-Bu Tan, possibly the greatest semiconductor venture capitalist in history. He left Intel's board of directors under the Gelsinger regime because he wasn't a fan. Once he came in, he had to end the runaway manufacturing train and raise cash in a hurry. And he's proved quite adept at that. First, he got $2 billion from SoftBank, $23 a share. Then he got $8.9 billion from the Trump administration, 433 million shares struck at $20.47. Then last night, he got that $5 billion from NVIDIA at $23.28 per share. It was instant gold for NVIDIA, as Intel stock immediately zoomed from just under $25 to $30.57 tonight. That's right, $30.57. Now, that was a remarkable move. In return for the money, Intel got a new partner in his PC and server business, where more than $50 billion is up for grabs, and NVIDIA really wasn't playing in that sector at all. That makes it a huge win for NVIDIA and Jensen Huang, because they got Intel for less than it's worth, and they'll never turn out more personal computer. They need the personal computer exposure, let's put it that way. Meanwhile, Intel says stays in business and can thrive if it executes. And I think it can under Lip-Bhutan. AMD, okay, new competitor, but Lisa Su's used to it. That's why her stock was initially down a lot, but bounced back. You can never count out Su. She's too good. More important, for our purposes, NVIDIA, which had seen its stock in the doldrums of late because of its China problems, broke out of that sphere of influence for the moment. I think today's news, where NVIDIA can spend a couple of hours worth of profits to make a hugely successful investment, is a terrific reminder there's a lot more to NVIDIA than China. And there's still a lot of money to be made in individual stocks, including the biggest one in the world, NVIDIA. Sure, the broader market may be hostage to the Fed, but you can't game the Fed. Even the president can't game the Fed, and he's sure trying. But can you game NVIDIA? Okay, here's what you can do. Stop the gaming. You can invest in Jensen Huang and his amazing team. Invest. You can let NVIDIA, a veritable index of chip companies, make you the kind of money index funds can't ever keep up with. You can own NVIDIA and not have to trade it. I wouldn't be so focused on NVIDIA today if it weren't for the fact that it's one of a handful of companies that seems very much in charge of its own destiny. When you look at the market, there really aren't that many stocks where you can say, hey, they're not a hostage to a quarter-point rate cut. That goes against the conventional wisdom. But when you have a company like NVIDIA that's rolling in cash, why would you care about borrowing costs? Now, if it were just NVIDIA that could control its own destiny and not worry about borrowing costs, then it would be different. But it's not just NVIDIA. We have a company like Meta introducing a new way to take information using eyeglasses augmented by hand gestures, even if the rollout wasn't ideal. We have a company like Apple, which introduces new phones with so many functions we couldn't have imagined a few years ago. We have a company like Alphabet that's introducing self-driving cars all over the place. All right, so today, Microsoft, Amazon, and Tesla were silent. That'll probably change tomorrow. So many people have tried to scare you away from investing in individual stocks for almost 25 years, and yet that's where all the money's being made and has been made. These experts don't even want to admit that the Magnificent Seven exists. They think it's too risky to chase gains in the individual companies. They hated me for coming up with FANG. Yeah, that was 12 years ago. I don't care. I got to deal with reality because my job is to help you try to make money, not pontificate and decide that you can't or shouldn't. The bottom line, if you want to make money in the market, you have to recognize that mega cap stocks are their own animals and don't have to be linked to the federal funds rate. If you want to ignore them and focus solely on some index funds that marches to the tune of the Fed, be my guest. But I sure wouldn't recommend it. You can do both. That's right. It's easier than walking and chewing gum at the same time. I want to go to Tom in Florida. Tom.
Thanks for taking my question.
Tom, my pleasure.
I'm wondering if MongoDB is a good AI play.
There are others that are much better. You know what? And I don't like to fool around with the AI plays. We got the best AI company in the world, which is NVIDIA. And I know it's moved a lot, but you know what? It's the best. And I like to buy it. The best. How about we go to Mark in Missouri? Mark.
Hey, Jim. Longtime club member, first-time caller.
Oh, I hope you like today's conference call, which is still available. It's available online. You can get that. I think it was a good call. How can I help?
My stock is Starbucks. I started a position in the low 90s. It's drifted to the low 80s. And my question is, do I buy more here or do I sit tight? Thanks.
I think you buy more. I think that what's happened here, frankly, is that it did get a little ahead of itself. The turn's taking a little bit longer. But you know what? It doesn't matter. We want to own this thing. It's like, remember when I sold Oracle because I got impatient? I never going to forget that, ever. And I think those who are impatient at Starbucks are making a very big mistake. My faith is in with Brian Nickel. I'd like to go to Kathy in Ohio. Kathy.
Hey, Jim, admire your show, insights, and work ethic. Got a question for you on Kroger's. Kroger's 52-week low, $54, 52-week high, $74. It's at $65.99 right now. I've made some money in 2 years, about 43%, 5 years, 98%.
Wow.
My question to you, should I be buying some more? I like
Kroger right here. I like Kroger. I think the numbers have been better than expected. Traditionally, I can't believe it has drifted down here. People worry about food inflation. I totally get that. They'd rather own Walmart. I totally get that. I like Kroger. I do like Costco even more, but Kroger's less expensive. How about we go to Mark in California? Mark.
Jim.
Mark.
How you doing, man?
I'm doing well. How about you?
I'm doing great, man. Thank you. Booyah.
Booyah.
Hey, so I was just wondering, what are your thoughts on SoundHound AI?
SoundHound? It's a meme stock. You know, I just am not into the meme. I mean, I'm willing to talk about the meme stocks forever, research the meme stocks forever, but own the meme stocks forever? No. Anyway, look, if you want to ignore the mega cap tech stocks and just focus on index funds, be my guest. They're hostage to the Fed. I like to be hostage to great business people who make me a lot of money. I think there's much more money to be made that way. On Mad Money tonight, well, from flying cars to quantum computing, speculative stocks are all roaring. But how much speculation is too much? I'm going to surprise you tonight. Then you stump me on Aquestive Therapeutics. Is this small cap with big ambitions just what the doctor ordered? I'll give you my take. And forget your average cup of joe. Wall Street's buzzing about Rock Coffee's recent IPO. And I'm pouring over all the action. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
How many speculative stocks can you own? This year, we've seen fortunes made in speculative stocks. And by speculative, I mean companies that don't turn a profit, or maybe they have some earnings, but you're paying a ridiculous multiple for them. I've wrestled mightily with this particular question for my Charitable Trust. I spoke a bit about it in today's Investing Club meeting. The answer might surprise you. I am actually all in favor of speculation, but it's got to be done wisely. In fact, if you're younger, I actually insist that you speculate, something that I made real abundantly clear in How to Make Money in Any Market. This thing comes out in a dozen days. In it, I offer a program for savings that involves a combination of index funds and individual stocks where you invest in 5 ideas and try to put every spare dollar into them regularly every month so your investments can compound over time. Own, don't trade, as trading is often a loser's game for individual investors. So at a minimum, if you're going to own individual stocks, you need 5 to make a diversified portfolio. And I think one of those ideas should be speculative. Maybe 2 if you're younger. It's killed me that the book isn't out right now because my wholehearted embrace of speculation will be paid off in spades today. Again, though, you need to speculate wisely. That means when you get a big win in one of these companies, you need to scale out of it gradually until you're playing with the house's money. And then you can rest and then I don't mind letting the rest ride. What examples of what speculation means? Let me give you some categories. All right, first, there are the richly valued stocks with real earnings, like Palantir. Here's a company that clients swear by because it aggregates data, uses artificial intelligence to find patterns that can turbocharge sales and earnings. People love this company. It's also got a cybersecurity aspect. Palantir is profitable, but the stock now sells for 277 times this year's projected earnings. That's why it's speculative. Second kind of speculation, thesis stocks. Case in point, America's short power. We need every kind of energy. We have to tap into hydrogen fuel cells. That's Bloom Energy. We need nuclear. That's Oklo. There are many others that fit the pattern, and they're all rocket ships. Oh, then there are the literal rocket ship companies. Rocket Lab, RKLB is the most visible. Don't forget flying cars, ones that have vertical takeoff, Joby Aviation. Quantum computing's been on fire. IONQ just signed a memorandum of understanding with the Department of Energy, an MOU with the DOE, to develop quantum technologies in space. When you see deals like this, they ignite D-Wave. We had them on D-Wave Quantum. Pretty interesting. Rigetti Computing, huge money losers. But their companies, their stocks can really rally on any positive quantum news. And there's plenty of news because theoretically, quantum computing is the fastest kind of computing. It's specifically endorsed by Jensen Huang, the CEO of Nvidia. Less than a year ago, he was very skeptical. Now he's a believer. So is IBM. Hardly a day goes by without some biotech announcing news about some new clinical trial. Unlike the others I just mentioned, these tend to be one and done. You'll hear from others later in the show. Now, understand that this market in particular has been supercharged by speculation. That doesn't necessarily make it dangerous, but part of it is dangerous. If you buy the high-risk stocks I just mentioned, you need to understand that they've already had remarkable runs. But you could have said the same thing 6 months ago, and you would have missed a great rally. I know that most people in the business look down on these kinds of stocks, and by extension, look down on me. But my job is to help you try to make as much money as possible legally. Owning a speculative name or two is perfectly fine, as long as you understand that you can lose a great deal of money when you're wrong. But if you speculate wisely, my exhaustive research shows that the good ones should more than make up for the losses. That money's back after the break.
Coming up, Cramer's on a quest to better understand this little-known biotech stock. Don't miss his take on Aquestive Therapeutics. Next.
Last Thursday, we had a tough lightning round because I got stumped by not one, but two different biotech names. Horribly embarrassing. And whenever I get stumped, I try to make it right by doing some homework and circling back once I can give you a real answer. So let's tackle the first one that I didn't know. Andrew in California, he asked me about a company called Aquestive Therapeutics, AQST. Write that down, AQST, with a pitch posed as a question. He says they want to make the EpiPen, obsolete by replacing it with a drug, get this, that dissolves in your mouth. I said I was intrigued. So is this thing for real? Okay, the thing about Aquestive is that it's been around for more than 2 decades, and for most of that time, it wasn't about an EpiPen replacement drug. It was about the delivery mechanism the drug uses, a kind of film that dissolves in your mouth, something that works faster than a pill and is easier than an injection. In 2010, the company got 2 drugs approved, including an under-the-tongue version of Suboxone, which is a treatment for opioid addiction. At that point, these guys were making money from the delivery mechanism, so they started to develop their own drugs. Eventually, Aquestive came public in the summer of 2018, but the stock hasn't exactly been a great performer. However, over the years, the company had some real operational successes. In 2018, they got an FDA approval for a seizure drug aimed at people with a rare type of epilepsy. In 2019, they got approval for their treatment for ALS. Then they developed a couple of drugs via their partners, one for Parkinson's and one for ADHD. But the stock never got much of a boost. The truth is, while Aquestive's been making money by licensing its drug delivery mechanism, it's not a lot of money. At the same time, the drugs they develop tend to be for pretty small end markets. From 2018 through 2024, this company's never done more than $70 million in annual revenue. And their single highest year for sales was 2018. Aquestive's never turned a profit either. It's no wonder the stock drifted down from $15 where it came public to the single digits by the end of 2018 and the low single digits not long after. Eventually, this thing bottomed at less than $1 in mid-2022, where it had a $30 million market capitalization. But for the past few years, this stock has found new life, climbing back to the mid-single digits, mostly thanks to the growing excitement about their EpiPen replacement that can be taken by mouth for emergency allergy treatments. The idea here is that with this drug, Anafilm, you can carry around a tiny little film in your wallet instead of a bulky EpiPen that needs to be stabbed into the body. You don't even have to swallow the film. It melts in your mouth. Even better, Anafilm reaches peak absorption in just 12 minutes. In other words, how quickly it can get to work, versus 20 minutes for an EpiPen. 8 minutes can be a lifetime on this. So I think people are right to be excited. If this drug can be approved, I think it could be huge. That's right, huge. We got some positive late-stage trial data from Anafilm in early 2024. Ever since then, the results continue to be very encouraging. Aquestive submitted its new drug application with the FDA in the first quarter of this year. The regulators are planning to make a decision by the end of January. In fact, earlier this month, we learned that the FDA will not require an advisory committee meeting to discuss Anafilm, which is usually a very good sign. That's why the stock's more than doubled over the past 4 months or so. However, after Aquestive's big run this summer, the company did a secondary offering, selling 21.25 million shares to raise $85 million. That's not great for existing shareholders, but they needed the money to launch the drug, and I'm glad it's already been raised. It's not going to be raised again. The real question here is whether it still makes sense to buy the stock at these levels. You need to understand that this is a totally binary situation. If Anafilm gets FDA approval in the next few months, Aquestive stock will soar. Probably have to do another secondary then. If the drug is rejected by the FDA, an agency that's had some major changes on its second Trump administration, don't know if you've noticed that, changes that make it unpredictable, then the stock's going to plummet. If you can't stomach that range of outcomes, please don't get involved. But man, I am inclined to bet on this story. I think Aquestive works as a speculative biotech pick because I believe the FDA will give this EpiPen replacement its blessing. And if that happens, you need to understand that you definitely haven't missed the move here. Aquestive is currently valued at just under $600 million, but management believes that their EpiPen replacement could do over $1 billion in annual revenue if it's approved. I'm not quite sure how aggressive that projection is, as the current epinephrine market is just $800 million in the United States. But Aquestive believes it can grow to $2 billion by 2031, simply because of the increasing prevalence of allergies. You feel that, you know that. Plus, they can probably get away with charging more for their dissolvable strip than a needle. Management also is assuming they can get to 50% market share right away, which seems optimistic. But then again, Anafilm seems superior in every single way. Easier to carry, no stabbing, faster acting. There are some other legs to the story, too. Because the outcome for the Anafilm decision is so binary, I don't think anything else is that important, but it's worth mentioning. Last year, Aquestive got approval for an acute repetitive seizure treatment, although the drug won't be widely available until 2027. Still, once it is, Aquestive expects more than $100 million in annual revenue from that drug alone. The company also has an early-stage gel treatment for alopecia in its pipeline that it says could do more than $500 million in annual revenue. But that's a long way from hitting the market. The bottom line, Aquestive Therapeutics is the kind of speculation that I can really get behind, as long as you understand the risks that come with binary situations where the stock's fate is totally in the hands of the FDA. So thank you, Andrew in California, for putting this one on my radar screen and forcing me to learn the Aquestive story. I think it's worth taking a chance on, but only with money that you can afford to lose. I want to talk to Steve in New York. Steve.
Hey, Jim. Love the show, man.
Oh,
love
thank
the
you, buddy.
moxie. Thanks for taking the call.
Well,
Hey,
thank you.
I'm a long-term holder. I'm an investor. I'm not a real big trader, and I've held it for years. Merck.
Oh, they've got some good stuff in the pipe. They've made a couple good acquisitions. The dividend seems safe. I think Rob Davis is turning the stock around. I think you continue to hold it. I don't want to buy more because I don't feel confident enough in the FDA because they can throw you a curve. But I like your long-term thinking about Merck. How about we go to Jay in Illinois, please? Jay.
Hey, Jim.
Jay.
Thank you for taking my call. And all the advice you provide everyone. Truly appreciate it.
Thank you. I'm teaching here. I'm teaching. I've been grilled by journalists because I got this new book coming out. And they ask me what I am. I say I'm a teacher. But you can teach on TV. It's not just like for terrible, I don't know, linear, whatever. So let's go to work.
Yeah, let's go to work. I have a sizable position in a healthcare company, bought during the pandemic at around $70 to $75 a share. The stock hasn't been doing well for a very long time. My question is, should I keep holding or selling or something else with Baxter International?
Baxter, oh my God. Baxter, go buy Abbott Labs. I mean, I got to tell you, Baxter has been such an incredible disappointment. It's painful. I don't know why they continue to disappoint. They are the king of disappointment, and that's saying something. The knight of disappointment or the bishop, they're the king. All right, let's go to Nathan in New York. Nathan.
Hey, Jim, how are you?
I am having a good day. How about you, Nathan?
I'm doing well. I was wondering if UNH is still a buy.
Okay, so UNH, when I read that they are throwing their weight around in Washington and spend a lot of time in the executive offices and really really making a point of touching bases with all the people who might be able to rub up against some of the people who are trying to hurt them, like maybe prosecutors. It makes me feel that UNH is bottom. And I did think that they could have the death sentence of being investigated for Medicare fraud. It does seem like that might be off the table. I don't, do I want to go buy it here? I would, if I bought it, I would buy it with calls. I would not buy it with common stock. All right, look, Aquestive is the type of speculation I actually can support. Just know that this is a binary situation with the stock's fate completely in the hands of the FDA, up or down. Much more mad money ahead. There's a new name brewing on Wall Street. I'm eyeing Black Rock Coffee after its IPO. See if you can maybe give your portfolio a caffeine kick. Then could an investment in Lens Therapeutics help your portfolio see clearly? I've got my eye on this small biotech chasing a massive global market, and I don't like the one we just went over. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Last week, we got this big bunch of IPOs, some more exciting than others, and you got to be careful with these. Take Black Rock Coffee Bar, BRCB, which came public last Friday at $20, well above the proposed price range, for opening at $26.50 and then closing at $27.53 on its first day. Hey, that's up a quick 37.7% from the deal price. That's how you make money. The stock then shot to a high of $30.40 on Monday, but it's now pulled back to $27 and change. Still nicely Black Rock. Hey, now, as you might imagine, Black Rock Coffee Bar is a coffee chain. It's got no relationship to Larry Fink's BlackRock, which we own for the Charitable Trust, by the way. Just a coffee chain founded in Oregon back in 2008, where they got their start as a drive-through only store. You know the deal. Now, Black Rock Coffee Bar has grown to more than 158 locations in 7 states. Roughly 60% of the locations are in Arizona and Texas. Management plans to grow their store count by 20% per year, the ultimate goal of 1,000 stores by 2035. In other words, they're trying to become a regional and national growth story, and we love those around here on Mad Money. Hey, this wouldn't be the first time that a coffee chain from the Pacific Northwest takes over the world. They've got a lot of hyper-caffeinated beverages on the menu. There's the Jackhammer. How about the Blackout? I got to tell you, when I hear about these drive-thru and I read these names, it feels an awful lot like Dutch Bros with Cramer fave, the Annihilator. I mean, look, that's all shtick. Then again, having followed Dutch Bros for years, I know this stuff is incredibly popular, especially the turbocharged energy drinks that account for 22% of sales here. Some people feel these aren't even coffee shops. They're energy drink places with some coffee thrown in. For those that aren't in the mood for caffeine, the company also offers a wide range of teas, lemonades, even hot chocolate, not to mention a bunch of food offerings. So far, Black Rock Coffee's been able to build up an incredibly loyal fan base. They have 1.8 million rewards members. These people make up 63% of their transactions. That's very good. So even though I'm a little suspicious that this is a kind of a knockoff Dutch Bros, I think it's worth looking at the numbers because they're excellent. Last year, Black Rock Coffee put up 21% revenue growth, which accelerated to 24% in the first half of this year. In the latest quarter, they put up 10.9% same-store sales growth, which is terrific, and that's up 3.9% in the same quarter last year. Nice growth. As for income from operations, after a torrid 195% growth rate in 2024, the first half of this year saw that slow to 84%. Still, that's nothing to sneeze at. At the same time, store-level margins, they've expanded very nicely, also unusual. Unfortunately, Black Rock Coffee is still reporting a net loss, but that loss has shrunk from 6.5% of total sales in 2023 to 4.5% of sales in 2024, but that number falling to just 2% of sales in the first half of this year. I like that trajectory. That might. Toughest part. What do you pay for a small coffee chain with strong numbers and huge growth ambitions? It is always difficult to value a stock that hasn't yet turned a profit and is in the early stages of expansion. So I'm going to use a price-to-sales multiple. We get to choose which ones we want. I'm going to use price to pin down how much investors are paying for Black Rock Coffee and then compare it to its peers. The company has a market capitalization of roughly $1.4 billion right now. And in the last 12 months, we have data for they did $179 million in sales, meaning the stock's trading at 7.8 times sales. That's not a small number. I mean, from some perspective, Starbucks trades at 2.6 times sales. Dutch Bros is a much closer comparison, trades at 6.6 times sales, despite being legitimately profitable. Again, much of Black Rock Coffee Bar's business is very similar to Dutch Bros, from the drive-thrus to the energy drink alternatives to the branding. Given that Dutch Bros was the last Oregon-based coffee chain to come public, it might be worth comparing Black Rock Coffee to what happened to Bros, B-R-O-S, when it came public in 2021. All right. You know, Dutch Bros was a more mature company at the time of its IPO. See, it already had 470 stores, 11 states, much larger presence in the Pacific Northwest. Just in terms of locations, that's about 3 times the size of Black Rock Coffee right now. Plus, Dutch Bros was already doing over $1.7 million in average unit volume in the year it came public. Black Rock Coffee's only about $1.2 million over the past year. I don't like that. That's low. Now, same-store sales for Dutch Bros only grew at a 2% clip in the year before the IPO, but that year was 2020, so, I mean, anything positive was seen as well positive. It also didn't hurt that the company-owned comps in the first half of 2021 came in at 9.6%. While Dutch Bros was also unprofitable very early on in its public tenure, that quickly changed. Despite that, Bros was a volatile trader for years. I mean, the stock quickly ran from $23 at its IPO price, mid-50s in the first few days, reaching $80 per share in the first few weeks. But it was clear that the market initially got ahead of itself, and the stock came right back down, falling as low as $20 in 2022. Didn't see 80 again until earlier this year. Not great. While some might see Dutch Bros as the more mature or even boring company compared to the new hot IPO, in a lot of ways, Dutch Bros still has some catching up to Rock Coffee Bar, even if they're ahead by a wide margin on locations. See, Dutch Bros has always, they got a strong rewards program. We've talked about that with Christine Brown. But they only just expanded mobile ordering to all their locations as of the end of last year. Mobile ordering now makes just 11.5% of their sales. Rock Coffee, 15% of their business is already digital. I like that. Plus, Dutch Bros had only just started expanding its food options, something that Rock Coffee's been doing for a long time. Honestly, this makes me feel like Dutch Bros has more room to run, though. Here's how I see it. Now, I don't dislike Rock Coffee Bar. But given that it's so similar to Dutch Bros, which has been an incredibly successful stock, and we've mentioned it to you forever, I think you got to ask yourself why the shiny new thing is better than what we already got. You could argue that Rock Coffee's at a much earlier stage of its growth trajectory, which could make for a better opportunity, but it also means there's a lot more risk. The bottom line, if you want an Oregon-based coffee chain, or at least it's one that started there, with drive-thrus and energy drinks that sound like they'll give you an immediate proverbial heart attack, I go to Dutch Bros. Nothing wrong with the Rock Coffee Bar. It's just that I think BROS has a much better risk reward. And Mad Money will be back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
You're going to be the whatever device activates Prindle that we no longer need. Prindle.
Activates what?
Pringle. Park, reverse, neutral, drive.
My God, that's like a 50s reference, old man. You are really in the Wayback Machine there.
It all starts at 9 a.m. Eastern.
It is time. It's time for the lightning round. That's right. I'm closing in San Francisco. My social media college. Everyone must have to be blend up. And then the lightning round is over. Are you ready? Ski that time. Lightning round clears. Oh, I want to start with Brian in Rhode Island. Brian.
Hey, Jim. Booyah.
Booyah, Brian. What's up?
I want to know what your thoughts are on this. It's fairly new AI company. It has partnerships with Google, Microsoft, and stablecoin Tether. It's called Resolve, RZLV.
Yeah, this thing's a rocket ship. I got to do more work on it. I can't cuff this one. It's look, the thing is straight up, and I never want to do that on a $7 stock. I've got to learn more. I am looking at our research director right now. We're going to know the $7 stock. We're not going to just opine on it with nothing. Let's go to Georgie in Pennsylvania. Georgie.
Hi, Jim. In my retirement, I've learned so much from you and through membership in the club.
Thank you.
Can't thank you enough.
Thank you. Good. I want that. I mean, just trying to teach here. How can I help?
Well, my question is on Western Union, where I've had a sizable holding from years back.
You know what? It's got no growth. It does have that big yield, but that's not what we want. We want growth. Growth and compounded income is how we make money here, not something like that. Let's go to Roger in South Carolina. Roger.
Howdy, Jim. How you faring?
I'm doing well. How about you, Raj?
Pretty fair. Jim,
right.
I want to say I appreciate all the work that you and your staff does because you got the best financial show on TV.
Oh, thank you. Thank you very much. If you saw where our staff live, we're like a bullpen in an away game. What's up?
I wanted to get you short and long-term outlook on Johnson Controls ticker.
Johnson Controls has done a very good job of moving into the data center. I do like Vertiv more, but Johnson Controls is a very good company, and it didn't used to be. Let's go to Jay in Florida. Jay.
Hey, Jim. Thanks for taking my call.
Okay, what's up?
I'm a first-time caller and a club member. I really appreciate all you do for us investors. Thank you.
Thank you for being a member of the club. How can I help?
Sure. I wanted to get your thoughts on Mountain Inc. So this company had a nice quarter, but the stock has dropped almost 35% since then. My question to you, Jim, is what is going on with Mountain, and do you think...
Well, okay, here's what happened with Mountain. I mean, the stock took off like just like a giant, a colossus. And then it reported a quarter, and the quarter wasn't that great. Now, we have to see another quarter because that was really a suboptimal situation. I'm not going to back it. Let's go to, honestly, I thought it was going to be a good quarter. I want to back it. I love the business. I just need a good number. Let's go to Randy in California. Randy.
Boy, Chick, congratulations. You're the realization of the American dream. You made me a small fortune. But what about Nordic American Tanker?
All right. How can I help?
Is Nordic American Tanker going to move up?
Nordic American Tanker? NAT? Oh, no. No, we're not going to be. That thing's 2323232323. Let me go to Steve in Florida. Steve.
Jim Cramer, how you doing, sir?
I'm doing fine. How about you?
Great, sir. Thank you. I'm calling about an AI data center hardware company that makes high-speed connectivity technology critical for AI servers. Revenue's up 274% year over year, with AWS and Microsoft as its biggest customers. This company is called Credo Technology.
Boy, there's so many new companies. I don't know Credo either. I mean, the homework is just piling up here. I mean, I'm like, I don't know. My grade is, I'm an incomplete. They're calling me letter I over here. Let's go to Drew in California, please. Drew.
Hey, Cramer, I just want to let you know, big-time listener calling from California, obviously. I used to follow you back when you were in GQ magazine.
Oh,
so
my,
today
that's 1993? Wow. Old timer.
Exactly.
All right.
Well, hey, I need a little help with OXY. I'm in it.
No, I'm going to give you help with OXY. You don't want to be in it. There's your help. That's all you need to know. It's an oil company and not even a good one. Let's go to Jim in Iowa. Jim.
Tim here. I've been paying attention to what you say for a long time.
Thank you. Thank you.
Kenvue has litigation risk down here, but it's at close to a several-year low.
I don't think the litigation risk is nearly as bad as people think. The stock is at 4.5%. It's got new leadership. I don't want to dump it right here. I just don't, but I don't expect a lot of upside here. That's the problem. And that, ladies and gentlemen, good of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Up next, Cramer's giving you a second dose of his biotech doubleheader. Don't miss his deep dive into another little-known name with big potential. Next.
Booyah, Jim. Your integrity makes you the booyah saint of Wall Street.
Booyah, Jimmy Chill.
Booyah, Jimmy Chill.
Booyah, Jim.
Quadruple. That's a lot of booyahs. Last Thursday, I got stumped by two different biotech stocks during the lightning round. So I promised to do the homework on both of them and get back to you with a more considered opinion. I don't like to cuff things. Now, this was a little unusual because both questions came in the form of what I call a pitch. We already covered Aquestive, so let's now turn to Joe in Illinois, who asked about Lenz, L-E-N-Z, Therapeutics, telling me how they've got this eye drop that can temporarily correct your vision. He said that it lets you read without reading glasses for 10 hours. I told Joe I'd look into it because doesn't it sound kind of interesting? But obviously, we have to do our own research on this stuff. Lenz was founded 12 years ago, although it only came public in March of last year, via a reverse merger with a little company called Graphite Bio. Now, ever since Lenz started trading, its stock has done very well. And you know what? It's got a nice, clean story. Even if I tend not to like reverse merger ideas. They're too complicated, and they often are a sign of a company not wanting to go through the traditional scrutiny of the IPO route. For years, these guys have been working on eye drops to treat presbyopia, meaning age-related farsightedness. Originally, they had two drug candidates, but a little over a year ago, they dropped the one that seemed less effective because the other one put up some terrific phase 3 clinical trial data. The FDA approved the eye drop at the end of July. It'll be sold under the brand name Viz, V-I-Z-Z, and the stock hasn't looked back since. Long story short, everything that Joe in Illinois said about the company does check out. Lenz does indeed plan to start sending out samples of the product next month, and they expect it to be broadly available by the middle of the fourth quarter. So how big is the market opportunity? According to Lens, there are 128 million people in the U.S. who are dealing with presbyopia and thus need reading glasses. Management pegs the total U.S. market opportunity at $3 billion. Now, according to the research, 60% of the 128 million people who suffer from farsightedness are interested in an eye drop solution. And that includes contact lens wearers, post-LASIK patients, and anybody else who hates reading glasses. In terms of efficacy, Lens says that 99% of the patients who take the drops achieved ideal pupil size to restore their close-range vision. 93% got 20/40 vision or better within an hour. All right, not perfect, but good enough to read. Within 10 hours after use, 70% of these patients were still at 20/40 vision or better. Now, Lens has a three-pronged strategy for getting these drops out to people. First, they're hoping for doctors to recommend the product, and they've built a big direct sales force to make sure that happens. Second, they're planning a consumer marketing campaign starting next quarter. Third, they're trying to remove all friction from the sales process, getting lots of free samples out there to ensure people can actually get their hands on these drops. And then working with online and retail pharmacies to ensure speedy reorders are possible going forward. Hey, I don't know, it sounds pretty exciting, right? And this big but, AbbVie, huge pharmaceutical company, came out with a similar product, an eye drop treatment for farsightedness that launched a few years ago. Theirs was called Vuity. Their version came out in late 2021 and had a pretty successful launch, but AbbVie's eye drops fizzled over time, and AbbVie could put any amount of money behind it. At an industry conference just last week, Lens Therapeutics CEO F. Schimmelpenninck was asked about Vuity, and he said, well, he learned a lot from that drug's mixed performance. Specifically, he pointed out that Vuity promised strong efficacy and a very strong response time, but then didn't live up to those promises. Viz, though, has a different mechanism, and according to management, it works faster and for longer. Basically, Schimmelpenninck argued that AbbVie's eye drops just weren't good enough. His eye drops are better. Now, this will be a cash pay product. That does hurt, by the way. Lens has priced Viz at $79 per month, or a 3-month pack at $198. For me, the biggest question is how many people are going to be so impressed with Viz's efficacy and convenience that they're willing to pay that amount for eye drops instead of just using cheap reading glasses? Overall, I'm inclined to believe that there'll be enough patients eager to try the product. We're talking a total addressable market of 128 million people. You don't need to get that many in order to have a big hit here. Of course, if you buy Lens here, you're not early to the story. The stock's it's up nearly 150% from its April lows. But many stocks are up big from their April lows. Still, I try to think of early stage, still unprofitable biotech companies like Lens in terms of market capitalization versus the total addressable market, or TAM, for their products. If you buy Lens here, you're betting that it's $1.19 billion market cap, $1.19 billion market cap, doesn't reflect the true scale of the opportunity here. And since I was asked, I'm not against taking a flyer on Lens at this point, right before they really start pushing the eye drops. It would have been better to spot this one before, but you have to pay a premium if you're coming into a biotech name after its key drug has already gotten approval. In the end, I think Lens Therapeutics has a promising story. And with the recent FDA approval of the company's lead asset, I'm optimistic that these eye drops can find their way to a critical mass of patients. I do, again, want to make it clear that with these smaller biotechs, the biggest money is often made during the run-up to approval and not the gains made once the approval occurs. The bottom line, maybe these eye drops for farsightedness fizzle like we saw with AbbVie's similar product a few years ago. But I'm betting Lens can make this thing work. If the drug's a success, the stock's going higher. It might even be maybe a takeover target, especially when you consider a big company like AbbVie coveted the class and the category. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.